When the RBA moves, your mortgage moves. But what is the cash rate, really? Banks in Australia hold accounts at the Reserve Bank, and they use them to settle payments with each other overnight. When one bank ends the day short, it borrows from another. The rate they charge each other for those overnight loans is the cash rate. It's a wholesale rate between banks, not one you can borrow or save at directly. So, why does the RBA care about a rate between banks? Because it's their main lever on the whole economy. Cut the cash rate and borrowing gets cheaper, so activity speeds up. Raise it and things cool down. The aim is balance. Inflation between 2 and 3% and full employment. That's the dual mandate. The board meets 8 times a year and announces each decision at 2:30 in the afternoon. Here's the part that reaches you. The RBA doesn't set your mortgage rate, your bank does. But the cash rate shapes what your bank pays for money in the first place. So, when the RBA moves, the bank's funding costs shift. The bank then decides how much of that to pass on. Your variable rate changes, usually within a month, and your monthly repayment changes with it. On a fixed loan, nothing moves until you refix. And it adds up faster than most people expect. Take a $700,000 loan over 30 years. A 1% rise in the cash rate is around $470 more every single month. If that rate held, that's roughly $170,000 in extra interest over the life of the loan. 1% never sounds like much, but on a mortgage, it's enormous. The cash rate isn't just a price, it's a signal. When the board raises rates, they're telling you inflation is running hot. When they cut, the economy needs support. And markets react the moment a decision lands. Share prices, the Australian dollar, even property auctions can move that day. You don't have to be a trader to use this. Knowing the rate is a forecast, not just a number. It helps you read what the news is actually saying. So, if you've got a mortgage, 3 things worth remembering. First, the cash rate is not your rate. You pay it plus a margin, usually around 2 to 2.5%. Second, a variable rate moves with the RBA, but a fixed rate stays put until its term ends. And third, banks don't always pass on the full change, especially on cuts. It's always worth checking what yours actually did. Kappa Brain. Make sense of money. Free at kappabrain.com.